Thank you, Art, but you took away the surprise. Right, the surprise is that the answer to the question, can the monetary system regulate itself, or if we want to consider the banking system as part of the monetary system, can the monetary and banking system regulate itself? The answer is yes. I better put my glasses on so I remember why. Now, I will grant that most economists will probably say no, but the idea today, the idea that a monetary system can regulate itself is actually one of the oldest ideas in economics. Some of you have been students in Professor Cardin's History of Economics Thought class, or what is it, Classical and Marxian Economics. Before the birth of economics as a discipline, there were a bunch of writers nowadays known as mercantilists. And on monetary policy, the mercantilists' advice to the king was the king should outlaw the export of gold and silver. Because if he didn't do that, the country might lose all its money. It might drain out to the rest of the world. It was the great philosopher David Hume who showed that that kind of fear was really just nonsense. And the way he showed it most convincingly was with the following thought experiment. He said, suppose we live in a world where the money everywhere in the world is silver coins, just for the sake of simplicity. Now imagine the people in England, sort of subset of this world, wake up in the morning and they find that they only have half as many coins as they had the night before. So each individual's holdings of money are half of what they were accustomed to, half of what they felt comfortable holding. Isn't it obvious, Hume asked, that people will react to that by trying to build their money balances back up? They don't have enough really to make the transactions they want to make. So how do you build your money balances back up? You try to sell more and you try to spend less. So in England there'll be less spending, there'll be an attempt to sell more goods, but with less demand for local goods and with more supply of local goods, prices in England have to fall. As prices in England fall, foreigners, people on the continent of Europe, are going to notice that English prices are now low. They're going to start buying more English goods. Meanwhile, people in England are buying less of imports because they're trying to build their money balances back up. So exports will rise from England. To pay for this excess of English goods over the goods they're now selling to England, the foreigners are going to have to pay for their increased purchases with coin. Silver's going to begin to flow back into England, right, to replace the silver that mysteriously disappeared. And silver will continue to flow in until people are satisfied that they've built their money balances back up, and until English prices return back to world prices or European prices. And at that point, the inflow stops. So the supply of money in the nation, following the initial disturbance, returns to equilibrium, right? It's a self-correcting process, and when there's too little money, the market will self-correct by attracting as much additional money as people want to hold. Similar sequence works in the other direction. If we imagine instead that people wake up and find they have double the money they had the night before, now they've got an excess money balance. They'll start spending more. That's going to drive local prices up. Imports are going to now become cheaper than local goods. English people will start buying more imports. That'll make coins flow out to the rest of the world in order to pay for the imports. So when this excess has been vented, right, when people are back down to holding the amount of money they want to hold, the outflow stops. So the outflow of money is both a symptom of an excess supply and it corrects the excess supply. So contrary to the mercantilists, the silly king doesn't have to worry that the money is all going to drain away. The quantity will regulate itself. The king doesn't have to hamper trade with restrictions that actually they're kind of pointless. It's impossible to bottle up money, but restrictions that aimed at bottling up money inside the kingdom. So that's the earliest example. In fact, it's one of the earliest examples in economics of a theory of a self-regulating order, and it's a theory of a self-regulating monetary order. The famous Adam Smith applied the same kind of lesson to the system he saw around him, which was a mixed currency, he called it. That is, it wasn't just coins, it was also redeemable banknotes. So the paper notes that people used that Right? Today we have Federal Reserve notes, but in Scotland in those days they had notes issued by private banks. Actually, in Scotland today they still have notes issued by private banks. If you've been there, it's interesting to see. In those days, in Adam Smith's day, the notes were redeemable for silver coin. So if you wanted to, you could go to the bank that issued it and demand coin in exchange for it. And Smith applied kind of Hume's reasoning to this mixed currency and said, if the banks issue more currency than people want, the way he put it was more than they can usefully absorb and employ, the same kind of mechanism will drain silver from the vaults of the banks. If the banks in the aggregate issue too much, prices will rise. In order to pay for imports, people can't export Scottish banknotes. People in London won't take those. They want silver coin. So they'll have to go to the banks that issued the notes, get silver coin, and export that. But that means the banks see their reserves of silver coin, the reserves they're counting on to be able to redeem the notes when the public comes and asks for redemption. They'll see their reserves leaving, and that'll force them to reverse the overissue. So banks are not able in any sustainable way to put more money into circulation than the public wants to hold. So like the pure coin system, this kind of mixed system is self-regulating with regard to the quantity of money, provided that it's anchored by redeemability into metallic coins. Even within the country, any single bank is going to be limited. It's going to be restrained from overissuing relative to other banks because its notes will get in the hands of those other banks. The banks in Scotland all accepted one another's notes, just like banks today accept one another's checks. And then they return them to the bank that they're drawn on and demand redemption. And so reserves drain from one bank to another very quickly. That restrains overissue by any particular bank. All right, well, that's some ancient theory as a background. So you may be wondering, doesn't our current financial crisis show that the answer to the question, can the system regulate itself, doesn't it show that the answer is no? Well, it doesn't. It shows that our current system doesn't regulate itself. It doesn't show that, in principle, a monetary and banking system can't regulate itself, because our current crisis is not a crisis that arose in an unregulated financial system or a free banking system. It arose in a pervasively regulated system, a perversely regulated system, a legally restricted, a hampered system. I got loads of synonyms. We don't have laissez-faire in money. We don't have laissez-faire in banking. We don't have laissez-faire in finance. We have not a silver standard, not a gold standard. We have a fiat money standard. Right? A banknote under a silver standard is an IOU issued by a bank. A Federal Reserve note today is an IOU nothing. You take a $10 bill to the Federal Reserve Bank and say, I'd like to redeem this, you'll get 2 5s. We have a government central bank, right, the Federal Reserve System, whereas in an unregulated system, in a kind of natural system, there isn't any central bank, but rather the issue of currency is handled by decentralized, competing commercial banks. That's sometimes called a free banking system. And of course we have heavy legal restrictions both on banks and on other financial firms. There's been some loose talk in the current crisis about it being the responsibility, the fault of deregulation. But if you look for details in that charge, you can't find them because, well, there hasn't been deregulation. The last thing that was partial deregulation was the Financial Services Modernization Act of 1999, signed by President Clinton, sometimes known as the Graham-Leach-Bliley Act. I had dinner with one of your economics professors last night who reminded me to give the proper name of the act. What that act did was to allow bank holding companies to become regulated bank holding companies to become regulated financial holding companies. So instead of just owning banks, they can now also own insurance companies, and they can own investment banks and other financial subsidiaries. That's clearly been a help in the current crisis because it's allowed troubled institutions to be acquired by these financial holding companies where previously they couldn't have been acquired by them. So Merrill Lynch could not have been sold to Bank of America if not for this act. Anyway, to be clear, I'm arguing that a free market monetary and banking system can regulate itself, not that our current system is self-regulating. If we want a more self-regulating system, we need to move in the direction of a more free market system in order to get a better regulated system. Right? So the term regulated is kind of ambiguous. It suggests that regulation as usually understood, which is a system of government guidance and restriction and supervision, gives us greater regularity, but actually that's the opposite of the truth. So we need to unpack it. We have legal restrictions, we don't have regularity. We have a crisis-prone system. If we want a less crisis-prone system, we need market regulation rather than the kind of regulation we've got today. There are basically going to be two elements to my argument. There's a positive element, there's sort of a positive case for believing that unregulated or free banking is going to work. It's going to restrain itself. And the case there is very much like the case for free trade. It's a case that indicates that the benefits are going to exceed the costs. Profit opportunities are going to be exploited. I got additional evidence of that today. I went swimming in the pool here. I didn't believe that it was going to be warm enough, but apparently it's self-regulating too. But down at the bottom of my lane, I saw a shiny silver object, and I thought, aha, an uncaptured profit opportunity. But no, it was a washer. So that opportunity had already disappeared. Now, why don't more economists believe that monetary system can be self-regulating? Well, there's honest opposition, there are honest doubts about the theory, or lack of familiarity with the theory, which is no longer so commonly taught. But there's also sort of historical myths that have become prevalent. And of course there are entrenched interests. There are people who benefit from being part of the current regulated system. The negative part of my argument is going to be trying to show that there isn't any good theoretical case to establish that government needs to or should provide money or regulate banks. The leading market failure arguments don't really hold water.